Good afternoon. Welcome to our City Different Investments 2026 Fixed Income Outlook. Joining me on the call today are fixed income co-portfolio managers Ryon and Sweta Singh. As a reminder, if you have any questions, please type them into the box at the bottom of your screen, and we will try and get to them during the question and answer session at the end of the webinar. Chris will kick it off by discussing the economy, starting with GDP. Chris?
We've gone through a government shutdown, which has given us problems with data. So that's why we titled this presentation "In the Land of the Blind, a One-Eyed Man is King, or Investing in a Data Desert." Now, we updated all of this data last week through year end, but a lot has happened in the week that has followed, which Sweta will be detailing. So the Fed has a conundrum, okay? It has a dual mandate, worried about employment and also worried about inflation. So let's take a look at the economy through the lens of GDP to see what it looks like. On the first graph, I'll give you a little background on these graphs. We have the yellow line, which is the actual data point. Then the dotted line above that is +1 standard deviation off the mean. The solid white line in the middle of the graph is the mean line, and the dotted line at the bottom of the graph is -1 standard deviation from the mean. It gives everybody some context around these time series. So right now, the economy looks to be in pretty good shape. GDP now, the Atlanta Fed's estimate of GDP for the fourth quarter, which came out January 8th, is 5.4%. That's pretty aggressive. Now, if we take COVID out of the equation, the economy, through the lens of GDP, even looks stronger. So again, our view of the economy is it's not bad. It's slowing a little bit through employment, but other than that, we have not seen a significant downtrend in GDP. At that point, I will turn it over to Sweta Singh to go through the first of the Fed's mandates, employment.
Thank you, Chris. And hi, everyone. Welcome. Happy New Year. I think I can still say that in the third week of the year. We think 2026 is going to be a very exciting year for the fixed income markets, much like 2025 was. And before I jump into the Fed and the dual mandate piece, I want to dive into the topsy-turvy geopolitical landscape for the bond market. And here is my PSA and a reminder to everybody of our investment process. We are a bottom-up credit shop, which means we look at individual securities and judge them by financial merits before investing in them. Our macro view is crystallized in terms of real rates. Remember, nominal rates minus inflation, as you've heard Chris say numerous times. Inflation, public enemy number one of fixed income investors. We look at credit spreads, which is the difference between your AAA versus BBB, trying to find relative value in terms of credit. Then we look at optimal allocation pockets along the yield curve. And we look at large data sets to find relative value for all fixed income risk vectors. Our mission as total return managers, which is to take risk only when we are getting paid to take that risk. So now, in this endeavor, we strive to provide a stable income or durable dividend stream. Now, the reason I brought it up and set up the context is because now I'm going to dive into geopolitics and volatility, which might seem scary. But our investment decision is impacted by geopolitics. However, it's not driven by geopolitics. It is driven by our fixed income total return mandate that Chris and I have honed cumulatively over the last 50 years and have ridden out cycles like GFC, remember 2008, taper tantrum, COVID, Liberation Day, to name a few. Okay, so what is going on? So This morning and throughout much of last week, President Trump is seeking immediate negotiations on acquiring Greenland for national security reason. Now, calling it a small ask compared to the defense shield that the US has offered NATO countries. And the US needs full control of Greenland because it's critical to deploying his Golden Dome missile defense system, and defending the territory not under US control would be impractical. Okay. How did Europe respond to that? The EU is on hold after European Parliament decided to freeze a ratification vote in response to President Trump's escalating threats to seize Greenland. Okay, what is the fear here? The fear is that European nations may diversify away from dollar assets in order to weaponize capital. We saw a small example play out yesterday where this Danish pension fund, Academia, and pardon my pronunciation of Danish here, it de-risked 100 million of US treasuries in the market. Now, you have to understand that in context of how big is the US treasury market, which is 30 trillion, and 100 million doesn't a dent make. We had US treasury market auction happened earlier today, which showed the strength of the US Treasury market. So again, volatility, headline risk. The more interesting sort of geopolitical event for us on the bond team is what is happening in the Japanese bond market, which is the Live Trust equivalent moment of what happened in UK in 2022. Now, the Japanese Prime Minister's I hope I say the Japanese Prime Minister's name right, Sanae Takayachi. The election pitch there was to cut taxes. Now, what that did was caused a bond slump with 30 and 40-year Japanese yield surging to 4.21%, which is sort of unheard in Japan. That last time it happened was 2007. And the reason I'm bringing all this up is Japan is the largest holder of US debt at this point. It is somewhere around 1.2 trillion, followed by UK at 890 billion. And in China, that used to be one of the largest holder, has now slid to the third place at $690 billion. However, I'm dovetailing all this geopolitical volatility crisis, if you will, with some good news on the US front. Remember that the Federal Reserve only controls the Fed fund rate and the short end of the US yield curve if you're looking at the Treasury market. But the longer end of the curve is controlled by the market participants. And in more of a normal environment, it's driven by US deficit. So now we have some good news as far as US deficit goes. The shrinking US deficit is a plus for bonds. Remember that now this US federal deficit has come down to a psychological mark of 5% of GDP that the bond market views as a positive. There's been a significant progress that has been made due to tariff and spending cuts. Now, new tariff revenues have more than offset tax cut elsewhere. Expenditure has kind of plateaued, improving deficit in the US markets, or improving the deficit. There are some risks here, of course. The Supreme Court could stymie some tariff implementation, which would be a risk. Also, 2026 is an important political year because it's a midterm year. And we could see tariff dividend checks going out in the mail, which would be a new expense. Okay, my long-winded way of coming back to the dual mandate, which is employment. Chris will talk about the 2% inflation mandate. I'm tackling unemployment. In our opinion, right now, unemployment or employment as a mandate, at least for the first 3 months of the year, will eclipse inflation. Even though we are looking at a strong GDP growth, as Chris was pointing out, we're not sure of the job market. The most important metric for me right now is the job market. In 2024, average job creation was around 111,000. In 2025, this ranged to an average of 30,000 in job creation. And in Q4 of 2025, this almost dropped to 22,000. However, for December this year, this number, non-farm payroll number, came up to 50,000. And that's the quote that we have on the screen, which is, the Fed Chair, Jerome Powell, estimated that the economy must add about 50,000 jobs per month to maintain the current unemployment rate, which is low at 4.4%. Now, why are we preoccupied with inflation? Not inflation, sorry, unemployment. Because there is a new animal or a new risk vector advantage on the market, which is AI. And you've seen that story play out in the equity market. How has that played out in the job market? Now, let's use Walmart as a proxy for US corporations. After all, Walmart is the largest employer in the US job market. And here is their Walmart's president and CEO's quote, Doug McMillon, who says, and it's a good proxy for other corporations too, it is very clear that AI is literally going to change every job. How does that translate? Well, there aren't job attrition or layoffs, but it's saying it expects to hold headcount constant. And that is also a trend that we're seeing with other corporations play out. Okay. Now here we have a bunch of data that I'll walk you through the main theme. Don't be nervous about all the numbers on the screen. So what we've done here is used both public and private data because, as Chris is referring to, we are coming out of government shutdown, unclear data, fogginess. So let's go first with the government data. I talked about that 50,000 job ad numbers that Powell has referred to. That was December. Fine, that's fair. Okay, why Z-score? Z-score, just to give you context, we're looking at large data series. So Z-score tells you how are these numbers reading in relation to average numbers that we look at in large data trends. So December's non-farm payroll numbers kind of fair. However, remember, they also revised negative 76,000 to the prior 2 months number. And as the Federal Reserve tells you, 1 month does not a trend make. So we will be watching this payroll number really, really closely, as will the Fed for the next couple of months. Now, ADP Challenger grade, these are private payroll numbers, fine, fair numbers. To me, what's more interesting is BLS, Bureau of Labor Statistics, and job opening. Remember COVID. I know, our memories are short, but not Chris or mine, because we track data going back to 1994 and longer data series. But remember COVID. There was 3 jobs to every unemployed person. So that number has shrunk to 1 for now. So that we think is weak, as in for every person out there looking for a job, there is 1 job opening. I won't talk too much about inflation because Chris is going to cover it in more detail. Remember, Fed's dual mandate is 2% inflation. That right now for December came to 2.6. Again, 1 month doesn't a trend make, but at least with regards to inflation, lower is better, closer to 2% is better. Core PPI is still hot at 3%. So really taking a step back. Employment, hopefully, it stays at that 4.4% unemployment number. So unemployment should remain stable, hopefully go down. Inflation also should go down to 2%. So those 2 Fed metrics, that's how we are seeing. I'm going to walk you through a couple more graphs because we're looking at the economy through the prism of employment data. Okay. All I want you to take away from this slide is unemployment rate. Currently, I mentioned 4.4%. You see that big spike, but that solid line, as Chris mentioned, is your average. It's pretty low. And that's the hope here, is to maintain low unemployment. Non-farm payroll, the magic number here is 50,000 that I spoke of, and that's tracking average. Again, the solid line we need non-farm payroll, think 50,000. job openings. As I talked about this earlier, you have one job opening, two people looking for jobs. Quits rate. Now, this is interesting. We'll spend 10 seconds here. So with quits rate, again, I'll go back to COVID. Employers were having a really hard time filling vacancies. Fast forward last 2 years, 2025, 2026. There's been so much volatility in terms of headline after headline flashing in, whether it's tariff, AI, what have you. So the employee, if you will, is staying put as it absorbs, or he or she absorbs how this volatile environment settles down. Employers are not laying off people, but employees also are not moving between jobs as much. And that kind of dovetails nicely into layoffs and discharges. It's sort of been stagnant. I've already covered job opening. Okay. Labor productivity. All I want to talk about here is new beast or new risk vector here is AI. Labor productivity looks really good here. We're not adding as much jobs in the market. AI, of course, GDP is looking really interesting. GDP growth is looking interesting. AI plays in bigly, if I can use that word, on labor productivity. So productivity looks good. Unit labor cost, for now, it's going down. AI is the new animal on the block where employment is sort of grappling with AI. And this is something that neither the Fed nor us as investors have seen before, as AI is a really big phenomenon, new phenomena, here to stay, and it will become a new normal, and the labor market will adjust to AI. Back to Chris on inflation.
So, as the last two slides indicate, productivity up, a good thing. Unit labor costs down, also a good thing. So what is going on with inflation? First of all, let's look at it through Milton Friedman's famous quote: inflation is always and everywhere a monetary phenomenon. You have too much money chasing too few goods, causes prices to go up. For that, he won a Nobel Prize. So let's move on to the next slide and look at some of the inflation drivers. So given that view of inflation, how do we measure money in circulation? That's through M2, money supply. And we can see that M2 has been growing consistently. Right now, that's about a 1.8 standard deviation event. But you need more than just M2 growth. As Chair Bernanke once said, if I drop $10 million out of a helicopter and people put it in their basement, that's not inflationary. So you need velocity. It has to turn over. And what we're seeing is that the velocity of M2 is increasing. Now, money supply is increasing, but at a decreasing rate. But with velocity increasing, that should lead to higher prices. Now let's look at what are the inflation drivers. We're looking at core CPI and core PCE. They're both high. One of the things that has happened because of the government shutdown is that the time series have become disjointed, so that we won't really have them normalize for another couple of months. But we can still see that inflation is sticky. And, why is it sticky? Well, we believe that inflation is being driven higher by tariffs. As a matter of fact, there was a study recently quoted in the Wall Street Journal this week that said U.S. consumers are paying 94% of the tariff increases. So that could also lead to why consumers view the economy much differently than the numbers indicate. So let's go look at the consumer right now. On the first slide, we see what is the University of Michigan's consumer sentiment. It's pretty negative. And then the Conference Board consumer confidence is a little different on the average. So what we have seen is that the president came on television and was telling everybody how good the economy was doing. he seems to be creating the same mistake that Biden created, in that you're telling people how they should feel rather than explaining why they feel like they do. So as we go forward, let's look at interest rates and how we structure our portfolios. We don't base the structure of our portfolio on forecasting where rates are. You know, our crystal ball gets really fuzzy after 3 months. So let's just look at the Fed funds rate. It looks a little restrictive by this measure, which is the real Fed funds rate. Fed funds less inflation, and we use core PCE. So as we go forward, thinking about core real Fed funds, it looks a little high, but nobody really knows what the normal level of Fed funds should be forecasting it. You know what it was in the rearview mirror, and that's the level where employment is constant and prices aren't moving too higher. So if we go to the next slide, we're going to talk about the three value metrics we use in putting together in structuring our portfolios. The first one is to look at real rates across the curve. And that is take a rate on, as in this graph, on January 8th, 2026, less the latest core PCE number, that gives us the real number. Then look how does it rate versus the long-term average. Well, in terms of standard deviation measures, it looks like 5, 10s, and 30s are somewhat fair, on the cheap side of fair. So what happens as we go forward? The next value metrics we use is looking at the slope of the yield curve. This is the slope, the difference in yields between the 2-year Treasury market and the 10-year Treasury market. It's approaching the long-term average, but still on the cheap side of fair. And as you can see, the real dip point was when we were at an inverted yield curve. So we've looked at two measures, real yields and slope of the yield curve, and they are fair. So we have constructed our portfolios to overweight the short end of each SMA's investment universe. Why are we doing that? It's pretty much because of the relative value that we're finding along the yield curve. We look at the middle column here, that would be the yield versus duration ratio for a 5-year security. And what this is telling us is that if you buy a 5-year Treasury security, you're getting 90% of the income of a 10-year Treasury security for only 55% of the duration risk. Duration is that element that says, how much will the price of my security change for a given change in interest rates? So that's a pretty good value. That 90% compares to the long-term average of 77%. So this is the driver right now as to why we are still focused on the shorter end of our SMA's investment universes. With that, I'm going to turn it back to Sweta so that she can talk about another value metric, that is credit spreads. Sweta, all yours.
Thank you, Chris. So here's a chart of corporate credits, corporate credit spreads. Corporate credit spreads are at the tightest level since 2007. Remember when we began this call, I was telling you about all the volatility. We didn't even cover Venezuela, Ukraine, what have you, that all the news headlines that flashes before us every day. The corporate credit spread here, and I could mirror the same graph for municipal bonds as well, shows you the health of the US economy in terms of corporations and public issuers. And what it is telling you is that it is the tightest it has been since 2007. So the headline volatility has not really percolated into corporations and US public finance issuers. So for now, credit spreads on both these sides remain tight. And in interest of time, we have not been able to share much about our municipal strategies. We will have a webinar that Michelle will share the dates later on, I believe February 5th, where we'll touch more on the muni market and the muni side. But on a really quick high level here on the muni market, right now, third week of January, we are in the throes of what is called the January reinvestment effect or January reinvestment period, where we have coupons maturing in January, July, coming up for reinvestment. Think about it this way, a lot of money chasing on the demand side, chasing not enough supply usually on, in the primary market issuance. However, this year has been different. For the 2 weeks behind us, the issuance has been 10 billion plus. So supply has been really robust. And it kind of leads into supply story for 2026 on the muni side that looks really good. Usually, we have been a supply-starved market on the municipal side, but for 2026, as we saw in 2025, municipal supply will be robust. Moving on to the last slide of our presentation today, where we're trying to tie it all together. The Fed is in between rock and a hard place. For all of 2025, that's what we were saying with regards to inflation. And now we will say this with regards to inflation and employment. We saw those rate cuts for 2025, where the Fed was really trying to goose up the employment picture. December, really good or decent unemployment and new job ad numbers. However, again, 1 month doesn't a trend make. So the Fed now is striving between the two mandates, 2% inflation, and to maintain low unemployment. We'll see that play out in the next 3 months of this year. Inflation, like Chris was mentioning, that has remained sticky, but it's trending in the right direction. Let's hope in the next quarter we see it come down to 2%. Chris talked about the consumer and the perception, more importantly, perception of weakening economy. I like a quote here from actually the Delta CEO when he was talking about, what segments of flight in terms of seating or booking seats were selling. Premium economy, premium class, business class doing really well, economy not as well. It kind of points to the K-shaped nature of the consumer, where the top quadrant of the K, if you hold assets, homes, stocks, bonds, that part of the economy consumer has done really well. The bottom quadrant, not so much. 2026 being a very important political year, we'll see more with regards to initiative. I'll pass it back to Michelle. Thank you, Michelle.
Thank you, Sweta. I don't see any questions in our Q&A box at this time, and we are coming up on our 30 minutes. We try to keep these to 30 minutes, but if you do have questions, feel free to email me, and we'll make sure that the portfolio managers answer your questions, and we'll reach out to you directly. One thing I wanted to mention is that we have just posted some new blogs on our website. The fixed income team shares a study comparing 3 of the most common ways that fixed income portfolios are structured and the results of each structure over the long term. As Sweta mentioned, coming up in a couple weeks on February 5th, we'll have our firm-wide market update webinar where the entire investment team from both the equity side as well as the fixed income side will be represented and sharing their thoughts on the market. So keep an eye out for the registration details. As always, if you have any questions or want to inquire about our cash management services, municipal or taxable separately managed account strategies, feel free to reach out to me directly. Thank you for joining us today, and enjoy the rest of your day.